This is Dan, Chief Option Strategist at MasterTrader.com. I'm going to show you an incredible, simple to learn strategy about shorting credit spreads around compelling turning points for weekly income. And then I'll show you our results for the month of October. I'll show you a trade that we just got out of and the strategy. What we're looking for is just turning points. People buy call and put options as a directional trade. When we sell options, we are taking the opposite side of that person's bet. We're saying, oh no, I don't think it's going to go below this support level. I don't think it's going to go above this resistance level. And we keep the premium that we sold as our profit, and we just manage in between. When people buy options, I call that a time-wasting asset. It decays into expiration. So you have to be right about the direction in a quick amount of time, or else most of the time you're going to lose money. We flip that on its head and put that time decay into our pocket, and we find the setups and the management with the chart pattern use of Master Trader strategies. These are the only three movements a stock can make: uptrend, higher highs, higher lows, downtrend, and sideways trend. So what we're doing in selling these credit spreads is we're picking the turning points. In an uptrend, we favor put spreads; downtrend, we favor call spreads; and sideways trends, we do both. We can sell an iron condor on something like this, and then we're taking in two sets of credits. We have a calculated advantage over buying or shorting stocks or ETFs. If the stock goes up and we sold a put spread, we keep the money. If it goes sideways, we keep the money. It can even go down all the way to our break-even spot, and we keep the money. Got this little baby over here saying, do whatever you want, stock. Just stay away from my short strike, and I keep the money. So it's a very simple strategy. The key is entry, going through our checklist, making sure they're liquid, small days to expiration, no pending news, no earnings, and an adequate premium. Like an insurance company or even a casino, we're receiving money over and over and over again, and then the key is about the management if you have a big move against you. So we have a defined edge, if you will. These are our results for last month. We track all open and closed trades for subscribers. This is our weekly options trader. It simply sells options and spreads around these turning points. As I explained, the goal to keep the premium, we manage in between as long as it stays away from the short strike. It netted 5,600. 78% batting average. Of course, we have stops. If the trade's not working, we exit and move on to the next trade, just like that insurance company. This is a nice visual here just to give you some pictures of the patterns that we're looking for. We call these just money patterns, and there's 7 of them here. What we're doing is we say that's a bullish pattern. I'm confident the stock's not going to go down under this certain strike price, under support, and we sell a put there. You could do it naked, but we prefer the put credit spreads because that lowers the amount of buying power required at the brokerage firm, and it also lessens your maximum risk in the event of an adverse gap or move against you. The credit received is your potential gain for putting on this position. If you sell one contract, that represents 100 shares of the underlying. You have an obligation to buy the underlying at the strike price on or before expiration if the option buyer wants you to. But he's not going to want you to as long as it stays out of the money. And the way our management is, that's all the time. Here's an example, Netflix. We literally just closed this like within an hour ago. Had an ugly gap on earnings, sold off some more, moved up, made a new low and reversed. We call this a W reversal with a new low plus. So right from this particular bar, right over this bar, it was just, a day or two ago, we shorted the 1095 puts under, right where this green line is. We shorted the 1095 puts took some of that premium received to buy the 1090 puts. Then we have a $5 wide bull put credit spread. You take in 60 cents a share net credit. If you did a 10 lot, $600 immediately hits your brokerage account. You keep the entire premium if Netflix closes above 1095 by expiration, which in this case is 4 days, 4 DTE. We just closed it a few moments ago at 10 cents, so we booked $500 on a 10 lot to avoid 2 days of additional risk, just like a prudent risk manager at the insurance company or casino. These aren't out yet, but I thought I'd share our holiday specials here. It's on our memberships, our bundles, our seminars, these advisory letters, the green room. Amazing specials. We only do this once a year. Go to mastertrader.com/October. Check it out. Email me, dan@mastertrader.com, with any questions on any of this information. Do yourself a favor. Check out this strategy. It's an excellent way to generate weekly income.